welcome back to Mortgage Markets and More. I'm your host, Peter D'Angelo from Rate. Happy Friday, everyone. I hope everyone's having a great week. We're going to get your mortgage rate update here today, and we're going to take a look at what's going on with the market. It's getting a little bit crazy on the day-to-day. So we're just going to kind of cut through the noise, go through what's going on in the market and why interest rates are where they are, as well as a little bit of insight as to what could be expected in the coming weeks. So starting off, here are the mortgage rates as per Mortgage News Daily survey, like we look at every Thursday morning before the episode's release. 30-year fixed-rate mortgage is averaging 6.94%. The 15-year fixed-rate mortgage is averaging 6.29%. The 30-year jumbo is at 7.05%. The 30-year FHA is at 6.42%. The 7/6 SOFR adjustable rate mortgage is at 6.43%. And the 5/1 SOFR adjustable rate mortgage, according to bankrate.com, is averaging 6.16% today. Overall, rates have edged up a little bit over the past week, and it's been a bit of a roller coaster. So our sampling is on a weekly basis. I could say that rates got a little bit better, and then they got a little bit worse. We're going to have to see that 5/1 SOFR adjustable rate mortgage did decline just a little bit from last week. That was the only improvement to speak of. Let's take a look at the bond market. That could give us some clues as to what's going on there. The 10-year yield this morning is at 4.346%. The 5-year yield is at 3.975%, and the 2-year yield is at 3.83%. They all rose modestly over the course of the past week, and that was really influenced by some of the geopolitical tensions, which let's talk about this right now. I talk about what's going on in the market on a weekly basis. It's an important thing to note. It's important to know about for context if you are a prospective buyer or seller or a real estate professional. It's good to know what's going on. That being said, all of this and every week, this is my little public service announcement today. I want to just make sure that everyone knows that this is so that we have the information, but at its core, this is a lot of noise. And it's going to continue to be noise. This is so that you can be armed with some knowledge as to what's going on right now. Your personal financial situations, if you're a prospective buyer or seller, your personal finances are the most important aspect. What's going on with the market is going to be what goes on in the market. However, you may have your needs for yourself, needs for your family. Those are the things that should take priority, and that would be my recommended lens to always look through when you're making considerations for purchasing. So, again, that's my little soapbox moment. I'm going to step off of that, and then we're going to now talk about what's actually going on in the marketplace here. So, here are the things that really drove the movement in the market. So first and foremost, the geopolitical developments. When I talk about geopolitical developments, I'm talking about particularly right now what we talked about last week, that U.S.-China trade war and the news about tariffs. Every time there's some news about it, it throws the market up and down. And as that happens, that creates volatility. Volatility creates interest rates that go up. Maybe they get a little bit of relief here and there, but when we're hanging on every thread of news, this is the way the environment is going to look. With that, we also have some, I would call it less than ideal optics for our Fed and for our president. Over the past week, there was some comments made by our president kind of throwing shade at Fed Chair Jerome Powell. That doesn't give investors a lot of confidence. So if the investors don't have a lot of confidence and they see something like that happening, that's when we start to see investors start to pull out of the bond market. You got to think of the bond market, which influences mortgage lending rates. The bond market, though, is U.S. debt that people are investing in, and it's supposed to be this safe place for investment. It has proven now to be pretty volatile, particularly over the past few weeks as this news keeps kind of throwing things up and down. So luckily, where we're situated right now, just yesterday, Wednesday this past week, there was some comments made by our president that actually said that he's not going to be seeking to replace the Fed chair, and he kind of eased off the rhetoric and the criticism of the Fed, which helped with investor confidence. So that's a little bright spot here very recently in the week. Now, the economic data is another thing to consider. These are things that are driving the markets in a big way. Inflation is always part of the conversation right now, and that's our first part that we talked about last week. We saw some better inflation data, but unfortunately, because of the conversations about tariffs and what inflation could look like in the future, the positive inflation news kind of fell on deaf ears. So right now, we're starting to see the tick ups in the producer manufacturing index, which is our little bit of I guess you could call it like a heads up, like we're getting a good look at what inflation could look like for the consumer eventually. And that's showing a bit of a tick up on the producer manufacturing index. So we could possibly see some higher inflation. We don't even need to see it in the data. The market starts to react immediately to something like that. So that's creating some more concerns about a higher inflationary environment. Unemployment ticked up only a little bit, but that's still something that could be a concern here. Even though it's not being reflected in the data, we've talked in the past, the data's delayed. So we're not getting the latest and greatest as of today, but the market is reacting today, and the data could be from 30 to 60 days ago. That creates some confusion, and that also continues to create this volatility because everything is staying so data dependent. Other than that, we also had some lead economic indicators that showed us some slight causes for concern about the future economic outlook. The Conference Board's leading economic indicator for the U.S. declined by 0.7% in March of 2025. We don't need to go into gory detail about what that is. We just know that is one of our, you can call it barometers for what the economic climate's looking like. And that indicates to us really that we have some potential economic headwinds. The overall market sentiment and outlook right now is that there's quite a bit more concern about there possibly being a recession. This doesn't mean that there's any reason for alarm right now. This is a conversation that's resurfaced a couple times over the past few years, ever since the pandemic and inflation rose a lot. There have been people calling for a recession throughout this whole time. The only tangible difference is right now there's a lot of conversation about tariffs. And when you're upsetting a status quo in an already tenuous situation, people are going to start to get concerned. People are going to start to get more conservative in their approaches. So what that has translated to for us right now, we're seeing that the U.S. recession risk by way of the surveys that are performed is up around 45%. And that's against 25% when surveyed in March. So this is because of the volatility we've seen, and there's a higher impact of like more recent information and more recent experience. So here we are in April after the tariff conversation earlier in the month. It makes sense that there's a little bit more concern about that. So I take that with a grain of salt. Also, the investor behavior. We talked about this last week. The fact that we saw the huge sell-off in the stock market and the stock market drop quite a bit, but then also the bond market not seeing the flood of people going to safe haven assets like we normally do, and maybe even some people selling off bonds, that kind of shows us a different type of investor behavior that's happening right now. And this could be because of the lack of confidence in the U.S. due to conversations that have been happening with our president not, really supporting the Fed and being very critical. That's not good, and that's poor optics. Our bond market and the bonds are mostly quite a bit of foreign investors. So if foreign investors are investing here and starting to pull out, that's a little bit more concerning. The other part of that's a large problem for the government in particular is the fact that we've talked about these bonds a lot. The bonds have a fixed value at the end of their maturity. So the government's always going to pay what that is when they issue the bond. But when people pay far less money for that bond, right? The yield, if the yield's higher, that means they're paying less money for that bond. That means there's less money going into the federal government, and their interest charge, which is the yield on that bond, goes up. So it's not a good situation for the bond market to be in the position that it is right now as well. So these are all these concerns that possibly investors have when they're looking to go to a safe haven asset, and the U.S. Treasury hasn't been that. And then lastly, global debt concerns. This is something that's been a conversation over the past week a little bit more. The International Monetary Fund warns that the global public debt will surpass pre-pandemic levels and pandemic levels, approaching nearly 100% of GDP by 2030 if it continues to pace at the pace that it's going. Debt is a problem across the whole world right now. So the key takeaways, like I said before, we take this all with a grain of salt, right? Take this with a grain of salt because this is just valuable information to help inform our decision making. It's not cause for alarm. Everything will work out. But for right now, this is the current state of affairs. It's volatile and it continues to swing in multiple directions. We're going to keep an eye on the Treasury yields. We're going to keep an eye on the outlook for the Fed. There's not a lot of, I think there's probably around 11% chance that the Fed cuts the benchmark interest rate at their May meeting. We're going to see what that looks like. They are going to stay data dependent, as has been the case so often. So as long as they're staying data dependent, we've got to wait and see. So we'll wait and see how the data continues to develop and what the Fed decides to do. That's it for our update this week. I hope you found this information helpful and useful. I'll be looking forward to providing you with the National Association of Realtors existing home sales data update. Part of the benefit of doing multiple episodes now is that I can do that when it comes out and much more closely to the release date, which I'm excited for. And then our Did You Know this week is going to be talking about appraisals and appraisal waivers. We talked about it before, but I thought let's talk about it now and also really kind of contextualize it with current information. So I'm excited to get that information to you. Be sure to like, share, and subscribe to the show. If you have any questions, you can always reach out to me at peter.d'angelo@rate.com. I look forward to getting you those updates for the rest of the week. In the meantime, have a great weekend and take good care.